45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
All right, everybody, we're going to be getting started here. Thank you so much for joining us today. I'm accompanied this evening by our 1031 exchange accommodator, Erin. Erin and I will be going over a very exciting topic, and that is 1031 exchanges. Erin, can you hear us okay?
I sure can.
Perfect. We'll go ahead and hop right in. Just going to quickly introduce myself. My name is Tasso. I'm a licensed realtor, have been for about 6 years now. Love it. It's my full-time job and I'm enjoying it. Have been with Marshall Reddick for about 2 years now and have loved every second. I received my bachelor's of business administration at Cal State University, Long Beach. I have 2 years of direct property management experience where I spent time coordinating maintenance, leasing property, handling vacancy, communicating with owners, tenants, just the whole 9 yards. Few fun facts about myself. I'm a husky owner to a 5-year-old Siberian husky. He keeps me nice and active. I am a student pilot recreationally, taking a few classes just to learn and get up in the air. And I love to play basketball. I'm out probably 2 to 3 times a week with my friends, family, or just on the courts playing pickup. I've completed real estate transactions in California, Texas, and Tennessee, and I'm an investor here at our Marshall Reddick Mortgage Fund. So the topics we're going to be covering today, Erin and I are going to be going into details on capital gain taxes. We're going to be covering the benefits of a 1031 exchange. We're going to be going over the basic requirements. We're going to be talking about what is like-kind property. We're going to be going over the exchange equation. And then we're going to be going through the timelines and rules of an exchange. They can be very precise. So Erin and I are going to be going into detail on these timelines and rules. So what we expect from you guys as attendees is we hope you learned something from tonight's event. So please feel free to take a notepad out or your iPad and take some notes. Please, if at any time during the webinar you have a question, type it in the chat. I will get it on my end and we'll take a moment to locate it. First question, Charles was asking where we're located. I'm broadcasting live from our Newport Beach office and we'll kind of go over our other locations in a couple slides now. If for some reason you have a question that you want a little bit more in-depth conversation on, please write it down and we will go over it in the consult. Also keep your pen or iPad handy to write down any links that may come up to reference back to them either during or later the event. All right, so some of you may be familiar with Marshall Reddick, but for some other people here, it might be your first time hearing about us. So we're a full service real estate brokerage and we have 4 divisions. So our first division is our real estate brokerage, as I mentioned. We help people buy and sell their primary homes as well as their investment property. So we did around 900 transactions this coming year. We're getting ready to close the year here. About 90% of which we manage, which brings us to our second division, and that's the property management division, our property management team. So we help the landlords really with all aspects of real estate so that all you guys need to do as clients and landlords is collect a monthly check. So we handle renovations, rent collections, leasing, maintenance, the whole 9 yards. Again, so that all you need to focus on is your family and your career, and we will handle the whole aspect of being a property manager. Our third division is our private money lender. So some people can't qualify for conventional financing and they need private financing. So Marshall Reddick offers non-owner occupied real estate loans to borrowers doing either fix and flips or financing new construction or purchasing investment property. And that's where our private money lender is and comes in effect. So then our fourth division is our our investment fund. So kind of like I mentioned that I am an investor in. So the same way you can own real estate and collect a monthly mortgage check or a monthly rent check, You can do the same in our investment fund. So you can actually own a mortgage and collect mortgage payments. So those are the 4 divisions within Marshall Reddick. And this is our national footprint. So thank you, Charles, for asking where we are. We are here in our Orange County office, broadcasting live from Newport Beach. We also have an office up in Los Angeles near the Pasadena area. We have an office in the Bay and one inland over in Riverside. Moving over to Texas, we have our New Braunfels office, our San Antonio office, and our Austin office. These are all connected by the I-35 freeway. The 2 major metropolitans are San Antonio and Austin, and right in the middle is New Braunfels, where we're seeing a lot of new construction being developed and where we have a huge foothold in our property management division. Our newest office is in Houston. Moving over to Tennessee, we have our Nashville office, which is a little bit south, and then our Clarksville, which borders right along with Kentucky. So a lot of the properties we manage are also in Oak Grove, Kentucky. So that's why you see that state highlighted, as well as a couple of our properties are up in the state of Kentucky. And then we have our office in Cape Coral, Florida. So what makes a good market? In the previous slide, you saw where we're located. We're not there by accident. We actually factor in all of the items you're seeing here. And this helps us to decide where we will be conducting our services, right? So this is exactly what we look for in a market when determining where to invest in real estate and where to ultimately move as these 1031 exchanges come into effect our money. If you're selling out here in California, where are you going? So we identify these Texas, Tennessee, and Florida markets. So we're looking for a good job market. The job market needs to have stable employment with unemployment under the national average. Super important, right? We're looking at vacancy rate in the states, right? It has to be low, meaning there's a strong demand for rental housing. Very important factor, right? We're looking at economic diversity, right? So we can't be reliant or dependent on just one job market. We want to see diversity. We want to see tech, healthcare. In Texas, there's one of the biggest military bases, same with Tennessee. So we're looking for diversity, manufacturing, government, so on and so forth. So we want to see economic diversity in these markets. We're looking for housing affordability, right? So this means that your initial investment, coming from a state of like California, oftentimes it requires a little bit more capital up front to get into an investment property. In markets like Texas and Tennessee and Florida, it might be a little bit less, right? So we're looking for housing affordability just for entry into these spaces. We want it to be landlord friendly. Texas, Tennessee, and Florida are some of the most landlord friendly markets, and they check the boxes of all the items you're seeing above. We want to see strong education. A strong education translates into white collar jobs, translates into promotions, steady income. We want to make sure that the people in these states are able to be good tenants, pay their rent on time. And then we're looking for reliable property management. What does that mean? That means that you as an investor, when purchasing a property and shopping for property manager, should have a choice of property management companies, right? We don't want to see 1 or 2 property management companies. That means that there is no business in that area. We want to see a lot of options so that you as the investor can ultimately interview these property managers and make a selection of who the best fit is for you. And that is a little bit just about the job market. Really, really one of my favorite slides here. This is a photo or photos from our last Christmas event. So these will be brand new here at our Christmas meetings and Christmas events. We're going to be redoing these for 2025, but this was taken kind of towards the beginning of the year. All these pictures in all our different states and offices. So at the top left is our New Braunfels office with the big blue sign that you can see from the freeway. Moving over to the right is our San Antonio office. It's a little bit south of New Braunfels. The bottom left is our Florida Cape Coral office. Right in the middle is our Newport Beach office, where I'm broadcasting live. And on the bottom right, we have our Tennessee team. And this is everybody from property management, realtors, IT, accounting. This is the team that really makes everything happen. So this is just a quick example that I'm going to go through here on one of our recent 1031s that made really good sense for our investors before Erin hops into her section. So we have here a single family in San Antonio, Texas. This investor bought the property March, April, May, June, July, in July of 2018 for $184,000. And then they sold it in January, February, March, April, May of 2024 for $260,000, right? They were getting a monthly rent of $1,695, and they 1031'd into a San Antonio duplex. January, February, March, April, May, June, July, August. It looks like they purchased it in August for $545,000. So they took all their earnings and moved it into a duplex, and then they were getting $3,500 rather than their initial $1,695 for their single. So they're getting $17,500 per door. And this was an example of a 1031 recently conducted by us, ultimately where the investor was cash flowing more, and they transferred all of their capital gains into a new construction duplex. So quick little example just before we hand it over to Erin to discuss in depth with you 1031s. Erin?
Yes, sir.
Thank you so much for joining us today, and we're looking forward to getting some good info from you.
Okay, do I have the ability to change it?
Yes, you do. You wanna take a sec? We're gonna just quickly, real quick before you begin. I think we have a couple of questions here.
Sure.
Are these determinants of a good marker in order of importance? If we discuss the job market and the things we look for, it's important that they check all boxes. Now, on a level of importance, some are more important than others. However, having all of those topics be in a market is super important. So we'll kind of touch base on that again, kind of towards the end of the presentation, but making sure that all of those, all of that criteria is in place when investing in a market, I'd say is very important. It needs to check all of those boxes. And then to quickly answer your question, Charles, thank you for asking. Yes, it is super important that all of those items are met in a job market. As far as importance on them, I'd say they're all equally as important in making sure that they're all available and making the perfect investment property. Thank you so much for asking. And then we're going to pass it over to Erin, who is going to touch on our 1031.
Okay. Now I'm afraid to touch anything though. I don't want to change anything.
Let me try clicking through for you, and you could just let me know when you're ready. Here we go. How's that? Oh, went one too far.
Okay. So I'm Erin Crowley with Asset Preservation, and we are a subsidiary of Stewart Title. We're one of the top national companies. I'm sitting here in beautiful Colorado, but I cover the whole country. So and we've been around for as long as there's been qualified intermediaries. So am I doing that, or Charles? Are you doing that?
That's all you. You're switching.
All right. Let me get back to where I was. Okay. So the wonderful thing about buying and selling invested property and owning it is the fact that it's a great way to build wealth. And we all know that buying and selling and buying and holding investment property is going to, in the long run, make us money. But when we sell these properties, we have taxes to pay. And that's one of the things that we want to do. We want to help you, instead of paying those taxes now, we're going to kick them down the road, and you're going to use that money that you would have given to the government, that you would have paid in taxes, and you're going to use that to increase your investment, to buy something else, to make some cash flow, to add to some things, so you're going to make more appreciation. So it's actually using your tax money for your own benefit, or to build generational wealth, or to build your own wealth. So that's the beauty of it. When we're talking about capital gains, I'm not going to go through it too much, but when you are selling an investment property, there's actually 4 levels of taxes that you're going to be looking at. And I have a lot of clients who forget about the first one, which is depreciation recapture. So the other great benefit of owning investment properties is that write-off that we get every year of typically we can come up with a loss because we are depreciating that property every year, and that's going to offset some of our expenses, and it's going to help us with our tax bill. But when we go to sell that property, that depreciation has to be all counted up over all the years that we've taken it, and the IRS is going to tax us at 25%. So it's kind of a wash because we've got to use it over all the years, but now we have to pay for it. So depreciation recapture is probably the biggest bite on the tax bill when we're selling an investment property. Then the remaining amount, or the appreciation, is taxed at the federal rate. So most of us are in that 15%, unless we're making close to $500,000, and then we're going to be in the 20%. So 15% or 20% is our federal rate. And then we added in 2018 the net investment income tax, or the Obamacare tax, the medical care tax, whatever you want to call it. But when you've got income coming in that isn't W-2 income, you have to pay this 3.8% if you're over a 250,000 bracket. So you may also have that. If you, like Tazo, you may not on your investment properties because you're acting as a real estate professional. So folks out there that maybe managers or real estate professionals, those you don't have to, but check with your CPA. And then state tax. We all have state tax. In Colorado, about 4.4. California's got some fairly high state tax. But those are the 4 levels that you're going to have to pay when you sell your investment property. But those are also the 4 levels of taxes that will get deferred in a 1031 exchange. Mm-hmm. So not only those 4, but also if you have any withholding for out-of-state purchases and out-of-state investors.
Yeah.
Tasso. Yeah, moving on to the next one, Tasso.
Perfect. Let me do it.
It's just not moving. It's moving every time it wants to, but not when I want it to. So this is the code, and it's very short and sweet, and it basically just says that no gain or loss is recognized on an exchange of property if you're holding it for productive use in a trade or business or for investment. So it's kind of a bonus that we get to use when we own investment property. It's not for primary homes. It's not for second homes. It's not for something we're going to fix and flip. It's only for properties that we're either using as our office or factories or our farms, or holding for investment like a rental property or a piece of land. And we get to not recognize that gain as long as we exchange it solely for another property or properties. We can do it for more, as long as it's the same thing, that it's real property that's held for either productive use in a trade or business or for investment. So we're going to talk about what makes it like kind and what we're going to do for how to hold it for investment.
Perfect.
Okay.
We got a couple of questions. If Daniel is on the webinar today, I was having a conversation with Daniel earlier today, who was asking me, is it possible to 1031 your investment property into just land, right? So this is kind of what we just went over here, Erin.
Yeah, and I'll address that just in a minute, but absolutely. So if you're having, the only time land doesn't qualify as like kind to, say, a rental or commercial or retail, is if you're going to subdivide it and flip it. So if you're just going to hold that land, or you're going to build rental units on it, or something, you're going to build a commercial property on it, those are all fine, and that qualifies that land. So just because you're selling land doesn't mean you can't buy a fourplex. Just because you're selling a fourplex doesn't mean you can't trade back into land, or both, or back and forth.
Yeah. So Daniel, if you're on the webinar today, that is kind of what what the topic of our discussion was today. So hopefully you got that information. We have a question here from Charles. After one does a 1031, how long should one hold the property before doing another 1031 with the same property? If this is something you'll go over, Erin, we can touch on it later down the slides, but that's a question we just got in as well.
Okay, well, I can answer it now because it's held for investment. So
Mm-hmm.
again, what the IRS won't qualify, if you're going to buy something and turn right around and fix it up and resell it, that doesn't qualify. So, or for investment is very vague. So they give us what they call a safe harbor. And the IRS likes to see a 2-year hold. So if you're buying a property, they want you to at least have the intention of holding that property for at least 2 years. If you have the intention to flip it, you're not going to qualify. Now, something may happen and you sell that property, or you need to sell that property, or even move into that property before 2 years is up. And if your circumstances warrant it, that's fine. It's
Mm-hmm.
just that they don't want that to be your original intention. They want you to plan on holding it. So you hold something for 2 years, you can go ahead and exchange out of that property and into something else. Now, if you sell that property and put money in your pocket, you're going to owe those taxes.
Yeah, makes
Okay.
sense. Sense. Thank you, Sheldon, for your questions. Yes, you will absolutely get a copy of these slides as soon as the presentation is complete.
Okay.
Yep.
I'll have you go to the next slide.
Sure thing. There we are.
Okay. So these are the reasons that we'd want to do it. One is just being able, did I spell that wrong? Just to be able to defer your paying that taxes so that you get to use that money to either buy a bigger property, a better property, or more properties. And that's going to bring you more wealth. So doing an exchange over and over and over is a great idea, because each time you're preserving that equity and you're using the leverage that, instead of paying taxes, you're using that leverage to get better properties or more properties. It's also great at diversification because, as Tazo was saying, there are good markets all over, but you might have a property that isn't in a particularly good market. It may have really high vacancies, or the affordability, like here in Denver, kind of went through the roof. That there's no more affordability, and and it's not very landlord friendly. So
Right.
I can diversify, and I can take my properties in less good markets and move them into a Texas or a Tennessee or Florida property that is going to give me a better return, or just going to be an overall better property. So I can diversify geographically from state to state. I can't go outside the country, but I can go anywhere within the country. And I can diversify by asset class. So as we just said, I can go from land to improved property. I can go from a building to a ranch. I can go from commercial to residential to retail, back to land, back to residential, or I can buy some of each. So I can diversify all the way across the board. And if you start early, then you can buy your single family rental, and the next one is a duplex and a fourplex, and pretty soon you've got apartment buildings, and you're owning triple nets all over the country. So it's the way to start and accumulate that wealth. And long-term planning, the estate planning is our goal is to basically build generational wealth. So as you're starting to build your portfolio with the help of the guys at Marshall Reddick, you're building and you're building and you're building, and you're selling and exchanging and selling and exchanging and living off of those that cash flow and refinancing when you need cash. But mostly you're building for generational wealth, because when you pass, we still have what we call a step up in basis. And that means that despite all the gains that we've deferred over the years into a property, if I had a property and I have $1 million worth of gain on it, if I sell it the day before I pass, I've got I've got all that gain to pay. But the day I pass, it goes to my heirs at a step up in basis. They get it at that $1 million, and all those gains that we've been deferring go away. So it's a way to leave properties and value to our heirs that we've built over generations. Okay, so next slide.
Thank you, Erin. Such great stuff, by the way. If you want to take a moment to answer 2 questions real quick.
Sure.
Hi, Kevin. Your question is fantastic. I think Erin covered it. You asked it early on in the slide, and I think she touched on it. Can you 1031 split one rental property into multiple investment properties?
Absolutely. So we'll talk about that just a little bit later when we talk about the exchange equation. But absolutely, I can take one property and put it into like 3 different states or 3 different properties, or a piece of property in the land next door to it. I can buy 1 property, 2 properties, or 40 properties, or 300 properties. I can also sell 5 properties and move them into 1 or 2. So we can certainly take a group of properties. And one of the things I think I didn't have on the benefits is that you can diversify, but you can also condense. And if I've been building my portfolio, and let's say I've got properties all over the country, but I really just want 1 property, 1 place for easy management, or maybe over time I want to live there, I can pull them all into 1 and buy that property. So we can go from many to 1 or 1 to many. It doesn't matter. We just have to make sure that we follow the pricing rules, and I'll show those in a minute. And these are kind of the cons of it, is that we've got rules and regulations that we have to follow, and that we've got to basically take all of our funds from our purchase into a replacement property. So I don't have any liquidity. I don't get to put money in my pocket. You don't get to recognize losses, but hopefully no one has those yet. And it's tax deferred. So at some point, if you don't continue to do exchanges, those taxes are just waiting for you. So it's you're deferring. Oops, there's my voice. We're deferring until we pass it to our heirs. So next slide there.
Thank you.
Okay. I think that's one of those multiple slides that build. So so these are the basic requirements. The main one is that you guys always hear that you can't touch the money, and that's true. But even if you just close before you set up an exchange, that's the same thing as touching the money. So you always have to have the exchange in place before you close on a property, even if it's that morning, you're closing that afternoon or the day before. So you have to have a qualified intermediary like me involved, so that I get on and kind of get in the middle of that contract, so that you, the seller, don't get constructive receipts of those funds. We're going to put them in a nice account, safe and secure for you, as long as and ready to go for wherever you're ready to buy your replacement property, but you can't touch it. I've got to hold it for the first 45 days while you're looking, but I can spend it for you. So if you close on your property in California today and close on a property in Tennessee tomorrow, that's fine. We want to make sure that we keep the tax paying entity consistent. So if you guys are in an LLC, that LLC is more than 2 people, then you've got a partnership, and that partnership is a tax paying entity, and we got to make sure that that partnership is also on the purchasing side. So whoever is selling needs to be the same tax paying entity that's buying. Sometimes it's a trust, sometimes it's an LLC, sometimes it's a partnership, sometimes it's just individuals. So we're always trying to make sure that that's all consistent. And it's always good to kind of either call me first or kind of look at these things first, so that this is done even before you list, and certainly before you go under contract if we need to change anything. The property qualification to like-kind property, we're going to talk a little bit more about that, but that's what I was saying. You can go from land to building, from building to retail to commercial to residential to industrial. And it doesn't matter what that property looks like, and it doesn't matter what state it's in. It matters how you treat it. It needs to be an investment property to you. If it's rentable, you need to be collecting rents on it. If it's land, it's land. You don't need to be having any cows or anything on it. If it's a commercial property that you're using, that's fine. That qualifies. So here, we'll keep going, Tazo.
Thank you, Erin.
Yeah, there you go. I think click it a few more times. Yep, thanks. So tax deferring, we get to, you're always going to be buying a property close to, equal to, or greater than the one you just sold. It isn't exactly like that. I'll go over that in the equation. You get to pull out commissions and title fees and my fee. Those come off of what you have to replace. But basically, you're going to be, if you sell for $500,000, you're going to be buying for $500,000 minus some closing costs. The timeline is always going to be the same. It's 180 days total from the first closing to the last closing. The first 45 are the crucial times. That's when we have to identify properties, and everything begins at the closing of the relinquished property. Okay, and these are calendar days. So I'll go through these just a little bit more towards the end, so I get them firmly in your brain. Sometimes it can be longer if your property that you're working on, that you're buying, or the property that you're selling, or your own property that you live in is involved in a federally declared disaster. So we've had many of those in the state of Florida and California, across the Midwest, and they actually will get more time if your property is involved in those. It could be shorter if you're closing anytime now to the end of the year and you file your taxes before you complete your exchange. You may have just cut off your time. So it can be shorter when we're talking to end of year closings. The identification rules, we've got 3 different rules, and I'm going to go through those. Let's keep going, and I'll cover those towards the end on a different slide.
Sounds good.
Okay, so constructive receipts, I've just touched on this real quick. That's what we just mentioned. We can't touch the money. So my job is to actually assign onto your sales contract and kind of momentarily become the seller, so that I take away your right to those funds and hold them. And then we do the same thing on the purchase side. We assign onto the contract on the purchase, and that gives us the ability to then use your funds to purchase, and it keeps you out of the loop of the funds. Okay. Next slide there.
Sure.
So, and we did talk about this, that the exchange entities, we want to make sure that the tax paying entity stays the same. Sometimes it's not exactly what shows up on title, because sometimes saying Smith LLC shows up on title, but Smith could be a single member LLC, and Bob Smith can buy the property in his name. Or it could be 2 people, and now it became a partnership, and only that partnership can buy the next property. So one of my jobs is to talk with you or your clients or whoever is doing the exchange and make sure that we're working with the right tax owner and that we've got that all lined up. Okay?
Yeah.
Next one. So like-kind property, we'll keep moving along here. So we'll do the next one. So we touched on this. It can be all those different things. It can be like-kind, warehouse, resort, all the way across the board. So whatever pleases you next, you can exchange into that one. But there are other things. Next slide.
Thank you.
So, but not everything qualifies. Most real estate is going to qualify unless you are going to be moving into it or you've lived in it. Now, if you've lived in something for a few years and you've rented it for a couple of years, that will still qualify you. Or if it's something that you're going to buy that you're going to rent out for a couple of years and move into, that will still qualify. But they want it to be a rental on this before you sell it and after you buy it. Second homes, that you have beautiful homes on the lake or up in the mountains or in the ski areas, if you just have friends and family using them, they don't qualify. Properties that you're going to flip or resell, or if you're a dealer or you're converting condos, those don't qualify. And if I have a partnership and I just want to take my interest in that partnership, maybe there's 5 of us and I just want to take my interest, I can't do that unless we change the ownership of that property, because I only own a partnership interest and not a fee simple interest. So if you're working with any partners and you all don't want to do an exchange, or you all don't want to go the same direction, that would be a good time to call me so we can walk that through. Those are some things that you want to do before contract.
Beautiful.
So we always want to have the intent to hold for investment.
Mhm.
Okay, so
We have a
slide.
very, very attentive audience today. Everyone is super excited with this webinar and asking a bunch of questions. I'm going to touch
Okay.
on a couple here. If we have a moment, we can take some of
Sure.
these questions. Thank you, Vinu. Should we do cost segregation before we do 1031 exchange, or else we can do 1031 exchange without cost segregation? Question mark. So he's touching on the segregation, the cost segregation beforehand.
So if you have a property that you can do cost segregation on, if it's especially commercial properties, you would want to do that first, and that helps identify what parts of that property you can do depreciation on and what parts of that property qualify for exchange. So you would want to do that first and then exchange into it, because bonus depreciation, some of that property that qualifies for the bonus depreciation, that may be a better movement for you immediately. That's going to give you some immediate benefits, where the exchange is when you're ready to sell it. So a lot of times when you first buy a property, you can do that cost seg, but they're often good things to do and almost always pay for themselves. So yes, definitely, if you can do a cost seg and it makes sense, that's something you should do.
Thank
Next
you, Erin.
question.
Tim, thank you for asking the question. He's asking, what if the LLC is in a different state?
So LLCs in different states doesn't matter. If I have a Colorado LLC, I can buy in Tennessee, I can buy in Texas, I can buy in any different state, or I can take my LLC and I can create another LLC, maybe that's in every particular state as well. So depending on the purpose, typically you're creating LLCs for that limited liability protection, and typically you want like a different one for each property, but you want to keep that tax paying entity the same, but it doesn't matter what state it is.
Thank you, Erin. Okay, we'll do two more and then we'll answer the rest at the end of the presentation. Charles is asking, does one need a QI for a reverse 1031 exchange?
Yes. So reverse exchange is when you're buying a property first and then selling. And you can't, if you actually went out and bought that property and then wanted to exchange into it, you couldn't, because one of the rules for 1031 exchange is you can't reinvest into property you already own or a relative already owns it. So in a reverse situation, you hire the QI to hold title to that property. We're going to take your money basically, and we're going to create an LLC, and that LLC is going to hold title to that property. And that gives you 180 days then that we're holding it in a different LLC, in a different kind of in a third party, an unrelated third party. And you now have 180 days to sell the relinquished property, the one that you're selling. And then as soon as that sells, we're going to transfer that ownership back to you. So you do need a qualified intermediary. They are more costly and they're a little bit more complex when you're doing a reverse exchange. So call me if you've got questions on that. A normal regular exchange is called a forward exchange, and that's where we're going to sell first and buy second. So we don't get on title in a forward exchange. We're just going to hold those funds. So
Great.
There's a little bit difference there.
And then we'll do one more before moving on, and we'll answer the rest at the end of the webinar. What is the rule for a 1031 exchange if the mortgage is in my name, but title is on me and my wife's name? So he's asking if he's on the mortgage, and but title is him and his wife together.
So, Chip, that's one of the things that we would talk to you about and say, how do you want to end up? So on your replacement property, it needs to basically be the same as your relinquished property. So the loan doesn't make as much difference as the way it's held in title and how you treat it on your taxes. So if you guys are filing jointly, then pretty much you both own that property. And the best thing to do would probably put both of you on title, because if you're married filing jointly, you're both acting as if you're owning it, because you're both sharing in the cost of it and any gains on it. So that's one of the things we say, probably do that, especially if you want to end up as husband and wife on the new property. So
Wonderful.
those are just one of the things we'll talk you through.
Thank you, Erin. Okay, we're going to click into the next slide here, and we'll touch on the rest of these questions towards the end of the event.
Okay, so split treatment has become since COVID, we have a lot more house hacking and people renting out their properties, and the rise of Airbnbs. So that's a little bit different than we've had in the 10 years before. So a split treatment is kind of a wonderful thing where we get to use both sections of the IRC code, 1031, which allows us to defer investment properties, and 121, which is our primary home exclusion. So when you live in your own property as your primary home, if you live there for 2 out of 5 years, out of the last 5 years, you get to use $250,000 basically per person, or $500 if you're married, $250 if you're single. And that is an exclusion, not a deferral. So it's better. You get to just exclude it. But there's a lot of instances that we're seeing that you can do both. So if I have a duplex and I live in half and I rent out the other half, I can use my primary home exclusion on half of it. And if I have additional gain, I can also then defer the investment portion. If I have a lock off or a studio or even a carriage house, or if I have a ranch and I live on the ranch, I can use my primary home exclusion for the part that's attributable to my homestead, and I can then defer the remaining part of it on my agriculture or my ranch. So when you're doing Airbnbs, we can do that. There's a lot of ways that it gives us an ability to use both of these very, very valuable parts of the Internal Revenue Code.
Thank you.
Okay, next. Yeah, perfect. So now we get to that exchange equation. Click it 2 more times to get those. It's one of those that builds. Perfect. So now the exchange equation is the most confusing part, I think, of the whole process, is how much do I need to reinvest to have full tax deferral, because it's not quite exactly what I pay for, but it is the value of the property. There's 2 ways of looking at it. One is take the value of the property, what you're selling for, and the cost of sale. So if we're going to be paying Tazo to help sell it, of course, we're going to be paying his commission, and that comes off of what we have to reinvest. It comes off of our capital gain. Isn't that great? So cost of sale is commissions, title fees, exchange fee. Those are the fees that we can pull off of the amount of our sale and not have to reinvest. So that comes to, and this one, so it comes to $850. Oh, sorry, and this one, hey, will you click one more?
Sure.
I like this. Yeah, I like this one better. So if I'm selling a property for $900, I'm going to have a cost of sale about $60,000. So the minimum I would need to reinvest is about $840. That's the same thing as saying if I took all of my cash, my $550 cash after paying closing costs, and I took my debt that I just repaid, and I replaced my debt with either cash or new debt, then I'm not going to have any boot, and that's going to be a perfect exchange. I could buy more than that, and I would have no taxable liability. But if I paid a little bit less, then I might have a little bit of tax liability. So again, the rule for full tax deferral is to take all of my net equity, all of the cash I walk away with, and put that into the next property or properties. I can put it into 1 property or 20 properties. And the debt that I just released, if I had a mortgage, that amount in debt, I have the choice of either going out and getting another mortgage for that amount or replacing that with cash out of pocket. but it can't go away. I still have to address it one way or the other. Okay, so questions on that? Okay, next slide. Oh,
specifically, I'm sure we'll get some. We have a couple that we'll kind of touch base on towards the end. If you want, we can take a minute to answer one or two. Your call.
let's go through these. Let's do one more. Let's do 2 more slides.
Alrighty.
And we'll get through the exchange equation. So sometimes you've got folks, you may want to buy less than what you're selling for. And in which case you're going to have what we call boot, or you're going to have exposure to taxes. So in this situation, we're selling for 900, but the property that we want is only 700. So we're going to put 100,000 in our pocket, and that's going to be taxable. It's going to be exposed to taxes. And we're only getting a mortgage of 260 instead of 300. So we're going to have what we call mortgage boot of 40,000. So this scenario will give us 140,000 of tax exposure or boot. That's just called a partial exchange. It's fine to do, but when I see these numbers, then I need to talk to the taxpayer and say, what is your gain on this property? And if they said, you know, we paid 100,000 for it, and I've got $800,000 gain on it, then they might be perfectly happy to pay 140 in taxes. But if they paid 800 for it and their gain's 100,000 on it, then having exposure of 140 means that the exchange isn't going to do them any good, because it's not helping them move that needle on their taxes at all. So it's always important, if we're going to be buying lesser price property, to kind of understand what our gain is and what our boot is. And go one more slide over there, Tazu. A couple more. So again, the main rule is reinvest. The first rule is reinvest all net exchange proceeds, and then have the same or greater debt or bring in cash. So if I went out and I just bought something that was greater than what I just sold, but I got a bigger mortgage and I put 140,000 in my pocket, I'm still going to have some liability. I'm still going to have some exposure. So that's why we want to make sure that the rule isn't buy more than. The rule is take all of your cash and replace that debt into one or more properties. And as long as you abide by that, you'll be fine. Okay. So, sure. And so the closing costs that come off, that you don't have to pay taxes on and you don't have to reinvest, are going to be those real estate commissions, your title premiums, your like escrow fees, legal fees, transfer taxes, and recording fees. So those are the only things that come off. If you're fixing the roof, or you're giving buyer credits, or you have property taxes, those or prepaid rents, those aren't included as exchange expenses, and they might have some tax implications. So those are always things that is best to run by us or your CPA. Okay, so next slide. So when the gain goes from one property to the other, this is the easiest way to look at it. When I'm selling a property, I'm going to, let's say I sell for 1.2 and my adjusted basis is 400 and I've got gain of 800. Now I'm going to reinvest into another property and it's 2.3 million. Well, normally that would be the basis in that property to figure on the gain going forward. But in an exchange, that 800,000 gain is going to lower my basis. So if I went the next day and sold that property for 2.3 million straight, I didn't make 0 gain. I made 800 gain, because that keeps following me. And so that gain from the first one falls into the second one and the third and fourth and fifth. So if you've done exchanges over time, you're building up that gain. So that's why we keep continuing to do exchanges, and until we finally either pass it to our heirs or live in a big glorious retirement home. Not retirement home, but a beautiful home that we were going to retire in.
Hey, Erin, are we also hoping for, when exchanging, we're looking for properties that generally generate more cash flow as well? Is that something we're also trying to identify?
Oh, definitely we want cash flow because it's
Right.
you know, we want appreciation, but we definitely want cash flow because this
Yeah.
is you're building by buying more properties and having that future appreciation, but you're
Mhm.
also building that cash flow. And
Yeah.
so, most of my clients are going to kind of live off that cash flow, refinance when they need to, and just keep these properties going. But when like I said, when the market changes, then you just exchange into something in a better market. So you can always be moving these properties around. And again, the IRS likes a 2-year hold,
Mhm.
but you can, you could basically move them every 2 years.
Yeah, so kind of like in the example I gave right before we started your section of the presentation, where our investor sold their single family for rent that they were getting of 16, I believe it was 75, and they exchanged into a duplex, and they were getting closer to 33 or so a month on their newer rent. They did roll that capital gain over, but ultimately their cash flow is a little bit larger with this, through this exchange. So something we're also looking into while you're 1031ing, deferring these taxes.
Exactly. And you're also, I mean, in those situations, you're also deferring some of your management because you're going from an older property to maybe a brand new property. So you're not, you're also leaving, you're making more money and you're leaving yourself of a lot of those responsibilities. So a lot of times we see people like moving out of older properties into new properties.
New
And
construction,
yeah, new construction is great.
maybe a little bit less vacancy because of the newer feel to it. Yeah, all super important. Sure.
Okay, so kind of next slide. So every now and then we do a two-party trade and that's when you don't need a qualified intermediary. If I want what Tasso has and he wants what I have and they're the same price, we can just we can just exchange those. But every other time that I'm going to sell something and do an exchange, I'm going to need to have a QI in the middle. Otherwise, it doesn't work. Otherwise, you didn't do an exchange. So that's what a delayed exchange is. A multiple property exchange just means that I'm selling one and buying many, or I'm selling many and buying one. But if I'm doing them in the same exchange, I just have one clock ticking, and that clock starts ticking when I sell the first property. So even if I might have 5 properties to sell, they need to sell in that same window, starting with that first one. Parking arrangements are the reverse improvements and reverse improvements. Those would be like a whole different class. Those I could spend an hour on each. So they exist. Call me if you want to talk about them. Reverse is when you've got to buy the property first before your other property sales. An improvement is when you need to buy the property and fix it up in order to get it to a value that you need. You've got more money coming out of your property than going into this one, so we're going to fix it up or add value to it. And a reverse improvement is when we're going to have to fix it up before we can buy it. And we gotta, buy it, fix it up before we can sell our property. So those are more complex.
Thank
Okay,
you.
but first let's go through the rules and then we can answer questions on. So this is what the forward exchange, keep clicking through this. I wish my things was working. Keep clicking through that. Yeah, till we get all the funny arrows. So this is what it looks like. Is that in a regular exchange, we don't take title to anything. We just magically get in the middle by assigning on to the contracts, and we hold the funds from your buyer as become the seller, and then we're going to use your funds as if we were the buyer. And that keeps the taxpayer out of the loop of the funds, but still direct deed. So they're still on the deed. The deed still goes from the taxpayer to the buyer. And again, all this has to happen in 180 days. These are calendar days. And the identification is the crucial part because you have to tell us what you're buying within 45 days. You don't get 180 days to choose something. There's no 90 days. It's only 45 from the day you close till midnight, where you've got to tell us what property or properties you're buying. Then you still have another 135 days to complete it. So if you're buying those new construction, beautiful properties that Tazo has in Texas, as long as you identify it, Then if it takes another month or so to complete, you have another 135 days to complete it, but
So
no
Erin,
longer than that.
super important that we're listing as many properties as possible then, is that right, when doing these exchanges, so that we can make sure one of them is our selected property? Basically what I'm asking is it okay in that identification period and when determining these properties to list many properties, or are we supposed to list a select few? Is it better to keep it safe in listing maybe a couple different listings or a couple different homes, or should we reserve it more?
So it's a great question, and the IRS is going to answer it for us. So let's move to the next 2 slides, Hazel, and we're going to cover that, because they don't like to make anything easy, and they much rather you pay the taxes. So hence all the rules. So you're going to have rules about how many you can identify. But first, we'll go through these rules just one more time. 45 days is all you have. You have to identify by midnight of the 45th day, and you need to have purchased by basically midnight of the 180th day. So those are the dates that should stick in your mind. Okay, so go to the next one, and that'll help answer your question. So the IRS, in their wisdom, is not going to say, hey, listen, give us as many properties as you can, because that would be better for you. No, they're not going to do that. They're going to limit you. So the first limitation is called the 3 property rule. Most of us are going to be using that 3 property rule. And that says that if I sell my property for 900, I can go and I can identify up to 3 properties, maybe one that I'm under contract and I love, and maybe one that I could live with, and one that I like. So I could identify the one I want and 2 alternatives, or I could just identify the one I want, and if I don't get it, I don't get it. But we allowed 3 property of any fair market value. So I can identify one for $1 million, and one for $950, and one for $890. Any of those would work. But let's say I was going to take my 900,000 and I was going to buy a lot of smaller, less expensive homes in Tennessee, and maybe I could buy 3 or 4 of them for 200 or 250 each. So I want to spread my money around a little bit, or maybe I'm buying lots or buying something else. So I can identify more properties. I can identify as many properties as I need to, but I'm capped at the amount. I'm not capped on the number, but I'm capped on the amount. So if I sell my property for 900, I can identify as many properties as I need to, but if I added them up the fair market value, I can't go over 1.8 million.
Gotcha.
Or twice what I sold my property for. If I happen to go over both of them, and I go over 3 properties, and I go over 200%, I fall into this very scary 95% rule that says that no matter what you identified, you have to acquire 95% of the value of everything that you put on that list. Nothing really can fall out, or you fail the entire exchange. So rarely do we see that. Most of the time, you're going to be in that 3 property rule, where you're going to identify the one you want and a couple of alternatives, or you're going to be in that 200% rule, where you're going to be identifying 4 or 5 or 6 lesser priced properties that you're going to spread your money around in.
So Erin, this is why, as an investor and as a person who's looking to take advantage of a 1031 exchange, it's important and it's crucial that you team up or you hire professionals who are able to know these rules, who are able to work within these timelines, and ultimately have properties and options available for you to fully take advantage of an exchange. It is very, very crucial to have that stuff.
I was just about to say that that's a realtor is very important, and somebody knows this is very important, because those 45 days are nothing. They fly by very, very quickly, and you don't get any gimme backs. You don't get any, please give me more time. It's set in stone. Right. And so those rules are important. Now, you want to be under contract. Nobody says you have to be under contract in 45 days. But if you can help your clients be under contract so that they've got a more certainty of close, or close within those 45 days, that's fine too. You can say, Erin, here's the contract for the one we're selling, And here's the contract for the ones we're buying, and one's closing on Tuesday and the new ones are closing on Thursday. So if you close them within the 45 days, then everybody can sleep well. If you close them close to that 45 days and you're under contract, then you've got a much more certainty of close. You don't just want to wing it, that's for sure.
Absolutely. Absolutely. Yeah.
Okay, so the next slide. So these rules came in the 1990s. So some of you probably weren't even born yet, but we had telecopiers, now known as faxes. We didn't have emails. We didn't have any of these things, but we still have these rules. And the rules say that we've got to, when we're identifying, we've got to do it in writing. We've got to unambiguously describe the property. So we can't just say something that's being built or something in Texas or something that's a two-family or something. It's got to be 123 Main Street, Unit 7. We have to deliver it, mail, fax, or email. So as long as you can email it to us, it must be sent by the midnight of the 45th day, and it has to be delivered to the QI, or the only other party that could receive those is not your realtor or your attorney or your accountant, but would be the title company that's involved. That's the only other party that's not disqualified. Okay, so I think we're done with the rules. If you want to go next slide. Yeah, I'm going to just finish up real quick and then take questions. So a lot of folks will say, hey, Erin, how did the IRS know that I did an exchange? How do they know that I didn't buy from a related party, or that I dropped out of my LLC and went to individuals, or changed my partnership? How will they know? And in these 2 pages is what you're going to file the year of the exchange that you do, and you're going to tell them exactly what you did. And here are the numbers, and here was my gain, and all of that. So this is how they know. Nobody else reports it, but this is how they'll know. And I think the last one, that one's a scary picture. So the last thing is you want to make sure that when you're doing a 1031 exchange, that you're working with somebody like Taza, who's qualified and who understands these things. And also we're again, one of the major, we're holding funds. So you want to make sure that we have all the bonding and everything else that's necessary. And again, we're part of Stewart Title. Doesn't mean you need to use Stewart Title, but they are our parent company, and they are a large multinational, multi-billion-dollar company. So write down my information, and I'm always happy to help. And then Taza's going to talk about some of these properties that I think are really exciting, and then I'll answer more questions.
Perfect. Yeah, we're going to go through some of these pro formas on properties that we would ultimately use as an example for if you were a person who owned a property looking to take advantage of a 1031 exchange. We would move you into some of these properties or properties that are similar to these. And then we'll take some time to answer some questions. We have a lot coming in, and we'll touch on all of them. Thank you all for participating today. So in Buda, Texas, we have these beautiful new construction duplexes, right? So if we kind of walk through the pro forma here, these are listed brand new construction at $649,500, right? So with a 30% down payment, $194,850, right? Initial repair cost of $0 because these are new construction. There is not any repairs that you're needing to make. Anything that we identified during the inspection period will be covered by the builder, right? Closing costs at 1.8, that's pretty standard, right? So the investment capital needed for this new construction in Buda is about $216, right? So gross rent for both doors is about $4,390. We're able to secure special interest rate financing at 4.75 rather than your standard 6.5 through the builders giving incentives, and through our connections with our preferred lenders, we're able to secure that 4.75 interest rate, which ultimately is bringing down your bottom line, making these properties cash flow better, right? So taxes are coming out to about $941 on this Buda duplex. Insurance about $150. In Texas on a duplex, our standard management fee is 8%. You're looking at another $323 in that. HOA fee on this Buda duplex is $108. No utilities because you're passing that along to the tenant, and same with the landscaping. So your fixed monthly expenses on a Buda duplex like this would come out to about $3,894 away from your mortgage, everything coming out together. Your monthly income on this one would be about $495.14, right? This is an A-class property. This property is going to appreciate. It's going to have very little maintenance. In Buda, you're getting a fantastic tenant pool. You're getting properties rented under 30 days. We're pricing them correctly. It's beautiful square footage, new construction. Like I mentioned, with these new constructions, we're able to secure that kind of lower rate buy down. So we have a lot of clients who sell multi-units, you know, in Los Angeles, and they'll 1031 into, you know, maybe a single family in one of these or 2 new construction duplexes. So this is just one fantastic example in our Texas market in Buda, the new construction duplexes. We'll move over to our Lehigh duplexes, a little bit of a lower price point, still A-class. The appreciation on these, or excuse me, the interest rates on these were quoted at 5.25, but it's still the standard 30% down at 164. Initial repair cost, given that these are new constructions, should be at 0. The builder should be covering this, but that's put in there just in case there are any small add-ons you'd like to make. We factor in that number conservatively. The closing costs at $11,000, right? So the initial investment capital needed on one of these to get in is $179,000, right? Your gross rent on both doors on these Lehigh properties are $37.90, okay? Same deal here with the interest rate being a little bit lower than the standard rate through the builder incentives at about 5.25%. Taxes are about $491, insurance $150, management fee at 8%, right? So this property we factored out, and it's cash flowing before all the maintenance and vacancy at $663,000. So your fixed monthly expenses are a little bit less than your mortgage payment. Again, still A-class, new build in 2024, 6-bed, 4-bath, so that's 3 2s on both sides. Another beautiful new construction property that you can 1031 in. These are just examples we're giving. I think there's 1 or 2 more on here. I'll leave it on the screen for you guys to take a little bit more of a look at it. Again, it's really important to look at the 15-year projected profit and return on investment, right? These properties are doing fantastic. They're showing fantastic numbers. And then we have a single family in Clarksville at 309, so lower price point, 1 door, right? A little bit more of a smooth transition if you're looking to get into just a single family. We do these all day. These are beautiful new constructions, right? So this was also built in 2024, again listed at 309, 900. The builders, by the way, on all of these pro formas are offering incentives to buy. And we could kind of discuss what that means in a consultation and go through that a little bit more. But again, we're quoting about 30% down on these is a good figure to allow these to cash flow, especially out of an exchange. It's a fantastic way to cash flow, right? So closing costs about 2.8 on these. Investment capital is a little bit less on these, about 101,000. Gross rent on this single family is $1,750, right? Again, that's priced correctly so that it sits under 30 days vacant, and we can get a good quality tenant in there. Again, we're able to secure lower financing on this, so your interest rate is a little bit less than standard through builder incentives and using our preferred lender. Taxes on these $166, insurance $108, 9% management fee for a single family, right? So it's a little bit higher for a single family opposed to a duplex. 9% management fee, HOA fees really low. So you're cash flowing about $100 on this with 30 down, standard rent, and that rate buy down, right? This is still an A-class property. This is still a new build. These still have builder warranty. So if there are maintenance items, the builder is typically able to cover a lot of that. You're getting fantastic appreciation on these and fantastic return on your investment. So these are just a couple of options when taking advantage of a 1031 for maybe an underperforming property, a property that has deferred maintenance, where you're getting a lot of calls from your tenants for plumbing issues, electrical issues, whatever it may be. It may be a great idea to 1031 into these brand new constructions where you're getting very few phone calls for maintenance. You're not sitting vacant for so long because they're beautiful and they're newly renovated and people see them, and it gives that new home appeal versus maybe an older one where you have a lot of work to do, and maybe the investment capital needed to bring that back up to standard isn't really going to factor or play a huge change on what the rent you can get is. So you put, you know, $50,000 to $75,000 in on repairs in your unit or in your home, and really your rent is kind of just slightly ticking up. It might be advantageous to 1031 into a newer construction like some of these, right? So we, again, you might have heard me mention that all the examples of the performers were A-class properties. How we determine that is through our Marshall Reddick rating ebook. We classify properties based on a number of items, and that can all be found in our ebook, and you can download it on our Marshall Reddick website. While on the Marshall Reddick website, there are hundreds of educational videos and articles on subjects like this, 1031 exchanges, we recently did a fantastic webinar or an online event with our tax person. There are all kinds of fantastic bits and articles and videos on our new construction, a little bit about our private lending, our property management team, and just everything related to real estate and what our company has to offer in our educational videos. So I would highly encourage you to log on to our website and look into all of those resources. Again, thank you so much, everyone, for logging on. My name is Tasso. Once again, I'm going to take some time because we got a lot of questions come in, and we're just going to touch on them very quickly, and then we will let you guys all enjoy the rest of your evening. Perfect. We left off right here. Hey, Erin, you're still with us?
I am.
Perfect. Mitchell is asking, I have 2 investment rental properties. Can I sell one to buy a cheaper investment property and pay off the mortgage on my second property? I believe you kind of touched on that a bit, Erin.
Right. You always have, you're always buying new properties. And you're always, so paying off something you already own wouldn't qualify. I mean, you could do it, but you're not going to get any tax deferral for it. So you always think that you're exchanging one property for another property that you or a relative do not already own. So you're always replacing one with something new, basically, new to you. So no, you can't pay off debt on something else and have any tax deferral on that. You've got to be buying another property.
Thank you, Erin. Kevin, thank you for asking your question. If invoking the 2 out of 5 rule, the capital gain tax is excluded, what happens to the depreciation that was claimed in each of the 3 rental years? Is that excluded as well? Not needed to recapture?
Depreciation recapture is a great question. Depreciation recapture is like a cockroach. It never goes away. So, and now even though it's your primary home, you have those 3 years of depreciation recapture. The IRS is going to want that money. So even though you're going to use your primary home exclusion on part of it, you get to use part of it. Say you moved into a property that was a rental. You've lived in it for 3 out of the, let's say you rented for 3 years and you lived in it for 2. So those 3 years you're going to pay not only the depreciation recapture on that, but you also will only get to use 2/5 of your primary home exclusion because you lived there 2 years, you've owned it for 5 years. The more you live there, the more you get to use. So it's a great strategy, but don't think that all your gain is going to just go away just because you live there. Now, if you live there and leave their feet first, then it passes to your heirs. But if you're going to sell down the road, you'll get the benefit of that primary home exclusion, but you'll also have that depreciation. So remember that you're always going to pay that.
Perfect. Hi, Kevin. Thanks for asking your question. Kevin is asking, what info exactly makes up the identification of the replacement property candidates? Would simply the street address suffice? I believe we discussed, you asked before.
It would. I mean, we're going to supply a form because sometimes people are going in with somebody and they're buying 50% of that property. So if it's under 100%, we need the percentage. And typically we're going to just ask that value of that property, especially if they're going to go over 3 properties. But truly, yes, you could just put an address, sign, date it, and get that to us. But we're going to be very customer oriented and make sure that you have a nice, fancy identification form that's going to have everything you need to know on it.
Yeah, yeah, totally. Vinu is asking, do people find out something to purchase beforehand, before getting into contract, sell existing and then close on the new property to be within the 45 days?
You can if you want to. I mean, you could certainly be under contract, like some of those beautiful things that Taza was showing. If they're not built yet, you could be under contract now. And as long as you've got some time, then you can sell your property and you're already under contract. So you can be under contract on the properties you want to buy. You just want to make sure that the one you want to sell closes first. Even if one's in the morning, one's in the afternoon, that would still work, but you want to sell first and then buy.
Yeah. Thank you, Erin.
The contract doesn't matter. You can be under contract anytime. And if you want to look first, that's perfect.
Mm-hmm. Yeah, absolutely. I agree with you. Hi, Sheldon. Thank you. You asked a question related to the monthly cash flow on one of the performas. Yeah, that is correct. The 6581 with 30% down and all those incentives on the interest rate being a little bit lower with the monthly rent. With 30% down, that is what we're seeing. If you're cash flowing positive, it is a good investment. On a single family, I believe that was the one in Tennessee. With as little as 30% down and all of those incentives, a 65 figure is good. It's important to keep in mind that not only are you making that $65 a month, your property is also appreciating over time. Your tenant is paying down your mortgage payment, right? So he is ultimately paying down the note for you. So there are plenty of other positives to that besides the $65 cash flow a month. But yes, that is correct. The 6581 is that cash flow there.
Don't forget about the tax savings too, because you're often going to have expenses and depreciation recapture, and typically that's going to give you a write-off on your taxes. So they have more benefits than just the income that you see.
Yeah, thank you, Vinu, for asking your question. How is the 15-year projected profit and ROI calculated over historic trends? We follow those same trends and we look at what the market is doing just in the future. We look at how the properties are performing in our portfolio and in the real estate market as a whole, but it's mostly trends over a 50-year period. We're factoring in those trends. You can't predict the future, and we understand that. However, the trends over a long period of time have shown a positive appreciation trend of these markets, and we use those trends to calculate those return on investments and projected profits over the course of 15 years. And then the last question, Erin, is for you here, and then we're going to go ahead and cut it off. Thank you all for staying. We went a little over time, so we appreciate you guys asking all these wonderful questions. Erin, the last question is, Charles did an exchange last year and is thinking about selling and buying something else this year. Can he do it within a year?
So it's going to depend on circumstances, and chances are sure, but if it were me, I'd wait till over a year just to cross over two time frames, or just to go into that just in case everything fails, you're going to have long-term capital gains instead of short-term capital gains. So if you go over a year, in the unlikely chance of audit, you would just have to have a good reason. I've had people who sold and did another exchange within like 6 weeks or 3 months, and that isn't 2 years or even a year and a day, but they had logical reasons. It wasn't working out for their business. You know, it's, if there's a true reason, then that's fine. But
right.
but the safe harbor is the 2 years. No questions asked if you do the 2 years.
Wonderful, wonderful. Okay. We appreciate everyone being on this event today. Again, a recording and a replay will be made available and sent to your email within 24 hours of right now. So please keep an eye out if you want to go back and look and take notes. You can always feel free to reach myself or Erin. I will be making call outs today and through the rest of the week just to follow up with everyone to see if they had any questions, get some feedback from you guys, and learn to hear a little bit more about your situations. It was a great time, Erin. Thank you so much.
Well, my apologies for the mix-up.
No, not at all.
For the temporary. I'm old. I don't know why I do that, but I apologize for that. So maybe you can just edit that part out.
Yeah, I'll check in. But other than that, no, it was fantastic. I think that we had a lot of good questions and we went over a lot of great stuff. I learned something. I learned a lot of stuff as well. So it's always great hearing from you. And thank you all again for logging on. Have a fantastic evening, and we'll speak again very soon.
Thank you.